The year is 2025. And if you're really paying attention, something feels off. Not on the surface, not in the headlines, but underneath the noise, beneath the optimism, the echoes are getting louder. The same patterns, the same behavior, the same blind confidence that appeared just before the greatest economic collapse in modern history. Most people see rising stock markets and assume prosperity. But the smart money sees something else entirely. They see 1929 all over again. When people think about the Great Depression, they imagine breadlines, bank failures, and desperation. But that's not where the real story begins. The real story is what happened before the crash. When everyone believed a crash was impossible, the Roaring '20s weren't just about jazz and cultural freedom. They were about a financial bubble so intoxicating that an entire nation convinced itself the party would never end. Sound familiar? Because here's the uncomfortable truth. Every major warning sign that existed before the 1929 crash is flashing again today. Wealth inequality, speculative mania, cheap credit, government intervention to keep markets afloat. We're not approaching a historical repeat. We're already living inside it. The only real question is whether you'll recognize the pattern before it's too late. Picture America in 1928. The stock market had been climbing for nearly a decade. Participation wasn't limited to professionals. Everyone was investing. Factory workers, farmers, shoeshine boys. People weren't buying stocks because they understood businesses. They were buying because prices kept going up. Credit was everywhere. Stocks were purchased on margin. People borrowed against their homes, convinced prosperity was permanent. Newspapers called it a new economy. Politicians promised that boom and bust cycles were over. Technology, they said, had changed the rules forever. That belief turned out to be catastrophic. And today, we are repeating the same mistake, almost line for line. In the 1920s, the Federal Reserve kept interest rates low to stimulate growth. Banks lent freely. Speculation wasn't discouraged, it was encouraged. Markets falling felt unthinkable. An entire generation had never experienced a true collapse. Fast forward to today. We've lived through more than a decade of ultra-low interest rates. Money has been cheap for so long that risk itself has been redefined. Entire industries survive only because capital is abundant. Venture funds pour billions into companies that have never turned a profit. Speculative assets dominate conversations. And just like in 1929, anyone who raises concerns is dismissed as someone who doesn't understand the new era. But here's where history becomes impossible to ignore. Wealth inequality today exceeds levels seen before the Great Depression. In the late 1920s, the top 1% controlled roughly 23% of all wealth. Today, that figure exceeds 32%. This isn't just a moral issue, it's a structural one. Because sustainable economic growth depends on widespread consumption, and consumption depends on a healthy middle class. When wealth concentrates at the top, demand eventually collapses. The wealthy can only consume so much. When the majority is burdened by debt and rising costs, the system weakens from within. This is exactly what happened before 1929. Leverage played a central role in the collapse. Ordinary Americans bought stocks using borrowed money. When prices dipped, margin calls forced mass selling. That selling triggered more selling. A vicious cycle. Today, leverage hasn't disappeared, it's expanded. Corporate debt is at record levels. Government debt has exploded. Consumer debt continues to rise. Student loans, credit cards, mortgages stretch to their limits. The entire global system assumes continuous growth. History shows that assumption always fails. What makes today more dangerous than 1929 is our level of dependence. Back then, many people lived locally. They had practical skills. They could survive disruptions. Today, we depend on global supply chains, digital infrastructure, and institutional trust. When confidence breaks now, the consequences will extend far beyond finance. And the smartest players already understand this. That's why billionaires are acquiring farmland. Why central banks quietly accumulate gold. Why insiders trade aggressively while publicly promoting optimism. Public messaging remains calm. Private positioning does not. The most dangerous phrase in financial history is simple. This time is different. It wasn't true in 1929. It wasn't true in 2000. It wasn't true in 2008. And it isn't true now. Technology evolves. Human psychology does not. In 1929, Revolutionary radio companies traded at absurd valuations. Today, it's artificial intelligence, electric vehicles, crypto, and speculative tech. Different labels, same behavior. Gravity eventually reasserts itself. When the 1929 crash arrived, it was swift. Markets lost nearly half their value in weeks. Banks collapsed. Confidence evaporated. Today, the vulnerabilities are even greater. Speculation exists simultaneously across asset classes: stocks, real estate, bonds, digital assets. And unlike 1929, markets are now fully interconnected. A crisis in one region spreads globally within hours. Algorithmic trading accelerates declines instantly. When selling begins, it won't be gradual. It will be immediate. Beneath the surface, warning signs are already visible. Commercial real estate is deteriorating. Banks hold massive unrealized losses. Pension systems take increasing risks to stay solvent. Meanwhile, trust in institutions has collapsed. When the next crisis hits, it won't just be economic. It will challenge the legitimacy of the entire system. Yet the response from leadership remains unchanged: denial, deflection, and doubling down on policies that created the problem. History teaches a harsh lesson. Crashes do not occur during fear. They occur during confidence. Maximum optimism, minimum caution. Every historical indicator is present. The stage is set. The actors are in place. And just like 1929, most people will be shocked when the curtain falls. History doesn't repeat itself, but it punishes ignorance relentlessly. The parallels between 2025 and 1929 are not coincidences. They are warnings, written in debt, in leverage, in human behavior. The echoes are growing louder. The only remaining question is whether you're listening. Before history demands attention the hard way. Your one subscribe can change my life. Please subscribe.